Welcome to Texas Property Tax Strategies with Chris Tejeda.
Welcome to Texas Property Tax Strategies with Chris Tejeda. Chris is an attorney at Boling Tejeda, PLLC in Allen, Texas, where he focuses on commercial property tax disputes and litigation. He works with business owners and real estate investors across Texas to challenge unfair property tax assessments. I'm LeAnn Lyon, and we are talking today about why properties are often overvalued in Texas and what property owners should understand about how those mistakes can happen. Hello, Chris. It's great to see you.
Good to see you again, LeAnn.
So, Chris, what are some of the most common reasons properties end up being overvalued for tax purposes in Texas?
Well, there are a number of reasons why properties may be overvalued, and it usually involves the initial valuation. The most common reason for overvaluations is the fact that appraisal districts use what is called mass appraisals for their initial valuations. Mass appraisal is a computer-assisted, systematic process of valuing a large sample of properties, such as everything in a city or in a county, as of a specific date, using standardized procedures and data. Essentially, appraisal districts input data into a valuation model or an algorithm, and that data usually reflects information of properties that have sold in the past 12 months. Maybe it includes information regarding zoning changes and building permits that were issued. It can also even include appraisal data from lenders, particularly federal lenders, who may be subject to open records requests. Another reason why properties may be overvalued is because oftentimes, especially in markets like Texas, buyers may pay above market prices for properties. Desirability is a main reason that properties are purchased in Texas, and if a buyer really wants to be in a certain location, they may pay more, especially if they're facing multiple offers on the same property. Why would a person pay more, you ask? Well, there's a number of reasons for that as well. One interesting reason I found is religion. For example, certain religions do not believe in charging interest on loans. So instead of the buyer paying for a property with a typical interest-bearing loan, the buyer may prefer a loan with no interest, but he then may pay a higher purchase price. Other reasons include buyers that want to move into a certain school district or buyers who want to be in certain tax-free zones so that their business can be competitive and remain profitable.
How does that mass appraisal system used by appraisal districts sometimes lead to values that really don't match the reality of a specific property?
This is a great question. Primarily, mass appraisal systems do not reflect the realities of specific properties because, well, each property is different and unique. These unique characteristics may not be accounted for in the mass appraisal model. Let me give you an example. Most of the valuation models out there do not account for specific occupancy levels of individual properties. There could be two office buildings that sit side by side and have roughly the same amount of leasable square space. However, if one property is 90% occupied and the other property is only 45% occupied, the mass appraisal model may not account for the property with the lower occupancy level and could value these properties at the same value. But one could reason that the property with the lower occupancy level should be valued less than the other building, especially if that one has more occupancy, and thus may be generating more revenue for the property owner.
So does that explain how differences between properties that look similar on paper lead to inaccurate valuations?
Yes, that is one of the reasons for sure. There are a lot of latent issues with the property that usually cannot be seen with the naked eye and don't appear on paper. For example, let's go back to our example with two office buildings, and let's further assume that the buildings are identical. They're both 10-story buildings with 100,000 square feet of leasable space and were built by the same construction company at the same time. From the outside, the properties look the same. But if one property is distressed, maybe it needs lots of repairs that prior owners have not done, or maybe it has a number of city code violations. Maybe one property is 100% occupied and the other property is 0% occupied because of a recent flood that caused the evacuation of the entire building. If this is not accounted for in the valuation, then the valuation could be erroneous.
So, in commercial real estate, how can income, occupancy, or operating expenses affect whether a property is being valued correctly?
So these three things, income, occupancy, and operating expenses, are key in most market value appraisals, especially if the property is an income producing property, like a hotel in which rooms are rented out for a night by a certain fee. There's a basic formula that appraisers follow, and that is the total income for the property less expenses equals the net operating income of a property, also known as the NOI. Once the NOI is calculated, a capitalization rate is applied to the NOI. The capitalization rate, or the cap rate for short, is a rate of return on real estate investments based on the income producing capabilities of the property and the riskiness of that investment. A lower cap rate leads to a higher asset value, and a higher cap rate leads to a lower asset value, meaning there's more risk. The funny thing about valuations based on income and expense and occupancy is that quite often the CADs do not have the specific financial data for each property. Thus, they have properties that are based on an estimate of the income of the property based on market parameters. The CAD will survey the area, find approximate market rents, for example, and then use that to value other properties. But a specific property that is less desirable than the market standard may command a rent that is less than the remainder of the market. Occupancy, on the same hand, is one of the most volatile traits of a property. Tenants come, tenants go. Obviously, a property that has a higher occupancy is maximizing its revenue stream, and more tenants means more rent. Allowable expenses are also critical in this valuation, as these expenses, like the amount paid for repairs, maintenance, and wages, can affect the bottom line of the property. These expenses reduce your income, and what's left is your net profit. Now, small incremental increases or decreases can dramatically affect the value of a property, so it's imperative that the CAD knows the specific income and expense and occupancy for each property in order to effect an accurate appraisal.
And just to be clear, when you're saying CAD, that stands for?
The Central Appraisal District.
Got it. Okay, excellent. So, are there situations where rapidly changing markets cause appraisal values to lag behind what is actually happening on the property?
Absolutely. The best example of this, if we can recall, is the year 2020, the year that COVID started. Remember that each year, the Central Appraisal District, or the CAD, makes a hypothetical appraisal of each property as of January 1. And this is as if the property was operating under normal conditions. So if you think back to January 1st of 2020, we were all operating business as usual. There were no or very few indicators of what would happen in March of 2020 as travel restrictions, mask mandates, and social distancing enforcement began. On January 1, hotels were still renting out rooms. People were still traveling for vacations. And then suddenly the movement stopped. Hotels that were renting out 60 to 70% of their rooms each night were renting 0 or maybe as few as 10% of their rooms. Office tenants vacated or sent all of their employees home to work, creating mass vacancies in office buildings. Sports venues closed to spectators. Now, please don't judge me, but I am a big Dallas Cowboys fan, and in fact, I have season tickets to all the games. But I did not see a single game during the 2020 season. Think about that. That's a huge hit to local businesses. Over 80,000 spectators go to each Cowboys home game during the regular season. That's 80,000 people who, in addition to the money they spend on the tickets, also spend money on parking, on concessions, on souvenirs. Well, all of that income ceased. We also saw the same thing during the Great Recession of 2008 and 2009. Home values were high at the start of 2008, but by 2009, many prices had dropped substantially as homes faced foreclosures. For a while, appraisers were not even allowed to use foreclosed sales as comparables for homes, even though these sales truly reflected the market. It took years for the values to catch up with the market in both situations, but thankfully, the values recovered in those instances.
So we've been talking commercial mostly so far, but for residential property owners, what are some common reasons their homes may also end up being assessed higher than they should be?
So the main reason for this is sales, sales, sales. Residential properties are the properties that convey the most in Texas. In fact, in March of 2026 alone, over 27,000 homes sold across the state. That equates to over 320,000 home sales per year in Texas. Now, each sale is just another data point used by the Central Appraisal District to determine values. Residential single-family homes convey from one owner to another more often than any other property type. Furthermore, homes that do sell are often updated or renovated in preparation for the sale, meaning that the sample used by the Central Appraisal District to determine value may be the best and brightest of the market and may lead to an overvaluation of homes that are not updated or have not been remodeled. Another reason for overvaluation of residential properties occurs less frequently, but we are starting to see this as some of the oldest parts of the state, where older, less efficient homes are being bulldozed and brand new homes are being built. Thus, you may have a brand new 3,000 square foot home built in 2025 in the same neighborhood and sitting right next door to a 2-bedroom, 2-bath house that is barely 1,200 square feet built in the 1940s. Well, here's a question you ask yourself. Should the land that sits underneath these two properties get the same valuation? Or is the land with the new house more valuable than the land with the old house? These are types of questions appraisers must answer, and oftentimes the appraiser and the homeowner do not agree, which leads to protesting of values.
So when a property owner does believe that their value is too high, what kinds of information or documentation can help show that the assessment may be inaccurate?
Well, there is no set list of evidence that can be used, and I have seen some very creative ways of illustrating value to appraisal districts. There are countless information types that can be used to help to support an accurate valuation. First off, especially if the property is income producing, the financial information of the property holds a lot of critical data. For commercial properties, your income statement and rent roll are good illustrators of value. Generally, during mass appraisal, the Central Appraisal District has based your value on a certain price per square foot, but your financials may show that you are actually receiving less income than the market. Information regarding needed repairs is also an indicator of value. A property owner that has an asset that needs $150,000 worth of plumbing work to update old pipes can make an argument that the needed repairs reduce the value of his or her property. Also, it's important to share what is unique or different about the property. Maybe the property looks and feels like other properties in the area, but it's actually much smaller than the others, or maybe it's much older than the others. This is rare, but maybe your property has asbestos that haven't been remediated, or it still has lead-based paint. I've been working recently with an owner of a laundromat who has had countless police reports showing that the property is burglarized multiple times a year. Even though the owner has made numerous security improvements and she's still spending over $100,000 per year in added security elements just for the right to conduct her business as usual. So it's very important that you point out the unique characteristics of your property.
Well, as we conclude today's episode, and this is coming from your experience working with property owners across Texas, what are some warning signs that a property may be significantly overvalued?
You know, in my opinion, I think every time the value comes out, there is a suspicion that it is overvalued just for the value coming out in of itself. You know, I see this most commonly and hear about this most commonly with Texas homeowners who will say, well, Chris, I've lived in my house for 5 or 6 years, or I couldn't sell it for the amount the appraisal district is trying to appraise my property for. And this is very common. That's why it's very important to get out and protest your value, even if you're unsure if you're overvalued or not. The good thing about it is once you protest, you are privy to some of the evidence that the appraisal district is using to value your property. And pointing these things out may be the reason that you're granted a reduction in the value of your property.
Excellent information. Thank you. And that is it for today's episode of Texas Property Tax Strategies with Chris Tejeda. For anyone listening who believes their commercial property may be overvalued or wants to better understand their options, you can learn more or contact Chris at bolinglegal.com. Thanks for listening, and be sure to like, subscribe to the show, and share this episode with someone who might need it. Thank you, Chris.
Thank you. Have a good one.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.